Hey, John. So we're talking deferred comp. I have two tales of good deferred comp and bad deferred comp, and I want to just talk through those, okay? And just talk through the concepts of deferred comp. And if your company offers it, help you try to navigate the decision, okay? So, first of all, what is deferred comp? And it is much like a 401k. In a lot of ways, it's like a 401k, but there's going to be one key difference that I talk about later. So you put money into your deferred comp, and then you don't have to pay tax on it now. And then when you leave the company, you get the money at times that you determine. And
Yep.
actually, sometimes you cannot even leave the company and you can say, I want it in 10 years. So you might say, okay, my kids are going to college that year. I'm going to want the money then. And then you can kick the can down the road again, like generally once. So then your kid is going to college, you're still at the company, you don't need the money, so you kick the can again. Does that make sense?
Yeah, yeah. Maybe it'd be
And
worth just talk about why did the company have a deferred comp plan? Like why is this case? I had a friend of mine that says, hey, suddenly I got this deferred comp thing. Like what's going on with this? Why not just 401k? Right? And
it gives
one of the reasons,
people, yeah,
yeah, go ahead.
it gives people a way to save more. What else do you think?
Well, one of the things that we see is there are certain rules around how much people can contribute to a
Right.
401k if they're highly compensated in technical language. So basically, the leadership of the company in many cases, founders and the executive level folks. There's some rules, and in some cases they might not be able to. We've had folks that are in as clients that can only, the maximum limit is like 20 or $25,000
Right.
from the IRS rules. Well, because they fit in this kind of subcategory, they can only put away $5,000 a year for retirement into their 401k plan or $10,000, right? They can't do more because of some of these rules. So then sometimes they'll have a non-qualified deferred compensation plan, which, as you said, like a 401k, but it doesn't have some of those other rules to it. So that's one place that we'll see that. And then there have been some other places where everybody's making a lot of money, but they're limited to what they can put in the 401k. If I'm making 50 or $75,000, putting away 25,000 bucks is going to replace a lot of my income. If
Right.
I'm making $500,000, putting away 25,000 bucks a year is not going to replace that much income. So that non-qualified plan can let me do more saving for retirement that's closer to my salary sort of thing. So that's a place. Sometimes I'll have people say, "Well, what? Why do we even have this thing?" Those are two places I see, and then there are where it's just go, "Hey, I want to save more," and that they're going to have that non-qualified deferred compensation plan, right?
Yeah, so I want to talk about another similarity to 401ks, and then I'll talk about why I almost never recommend them. Okay, deferred comp programs. Okay.
Yeah.
So the other similarity that makes it seem very much like a 401k is that you get an account and you can pick investments from this account. Okay. And so your money gets invested in the same in whatever funds you pick. All right. And so then you can see it grow. So, and you don't pay tax on it until you get the income. So that means it grows deferred. Another similar to 401k and is good. Right.
Right. Right.
Okay. So here's why I don't like these. Unlike the 401k, where the money has to be actually set aside with a custodian in a separate account, this is, I call it like a hypothetical account. It doesn't have to actually be funded. So one reason the companies like it is because they can pretend like they're paying people, but then if they go bankrupt, there might be nothing there for the people. So that's and people might think, well, my company's solid; it's never going bankrupt. But yeah, the history's littered with people who thought that and then worked at a company that went bankrupt. So if the company goes bankrupt, you are not on top of the list. Employees are on the top of the list for getting paid back. Okay, so then after the employees are paid back, then we can hope for deferred comp people. It just depends on how the company is and how the
Yeah.
bankruptcy court works. And these highly paid executives that deferred a lot of their compensation and then had it supercharged in stock funds that are hypothetical, that are not actually on any, like really accounted for or any really anywhere really. I call them hypothetical accounts. You can lose all your money, and that is a risk. And so that basically what you're doing then is you're saying you're investing your money in a S&P 500 or something. An S&P 500 doesn't have, it has some risk, it has plenty of risk,
Sure.
but people don't think it's going to go to zero. I mean, that would be, that's a much higher risk than going to zero. So companies go bankrupt all the time, but the S&P 500 is always chugged along, even if it goes down.
Yeah.
So the risk in a private company or in an individual company, pardon me, is just so much higher. So all you're getting is market returns, but you're taking on a lot of risk, and you're not getting paid for that. Okay, so
Yeah.
there's
Yeah.
some complaints. What are your thoughts? I don't know if you say
Yeah,
this.
no, I mean, it's exactly how we explain it. You become a creditor of the company, right? So
Right,
they've got, you get a statement that says what the balance is, but it's not, but that's their promise to pay you in the future.
right,
Kind of like when you go to work for them, their promise is that they're going to pay you for the work that you do, right? And so
right.
there's no cash account set aside for those things, right? Of course, the difference is I work for 2 weeks or a month and they pay me. There's a really short time frame for them to, right,
And it's
to
only a
pay me as
specific amount of
opposed
time. Yeah,
to 10
right,
years, right, down the road,
right.
that sort of thing. So I think that's exactly right. Is you're taking on some additional risk, and some folks are comfortable with that. Some aren't. Like I said, I think people tend, as you say, to be a little bit more, geez, my company is real solid, right? And that, like as you said, the history is littered with companies that were solid until they weren't, right?
Right.
The one place where we do see it make some sense, or where I will recommend it, and it depends if how much on a relative basis a person is going to defer into that, but doing some tax bracket management, right, where you say, listen, if I'm in the top tax bracket now, and I'm pretty reliably sure I'm not going to be in the top tax bracket in 5 years when I retire, do I want to do non-qualified deferred comp for the next 35 years? Probably not. For me, anyway, personally, I'll say, listen, if it's 5 years, are there any guarantees? Nope. Is it a little more solid that, hey, in 5 years, that's probably not going to, go to hell in a handbasket immediately? Hey, maybe I've got a better feel for that. Maybe I can point to, I know I'm retiring because I'm going to be, 60 or 70 or whatever years old, and I know that my taxes are going to go down, so I want to take some of that money out down the road. Like that could be a place where it makes some sense to do for sure. But and you mentioned this, but I think people forget about it that so one of the great things, right, is I defer $100,000 into my deferred comp plan. I don't pay tax on that today. That's the selling point. Great that my taxes are lower today. At some point, all that money comes out and it's fully taxable, right? And if you're not thoughtful about it, and there's different ways you can choose. And you mentioned we've had folks that say, hey, I'm going to line it up so it pays for college. Well, that increases my taxable income in those years. And maybe I don't necessarily want that in those years. Or it can be a lump sum. Hey, in 5 or 7 years, I get a lump sum. And we've had people go, suddenly you go, oh, wait a minute. Now I've got just as much income 10 years down the road or 8 years down the road as I would have had if I just paid it today, right? So in some cases, it can be a little bit like robbing Peter to pay Paul, sort of a feeling. Not that it's wrong necessarily, but you go, okay, wait a minute, let's be thoughtful about that. And for me anyway, the shorter the time horizon, the more that sort of tax arbitrage or tax planning is more likely to be beneficial, right? But it's not, like I said, it's not panacea and it's not just free money sort of a thing, right? There's downside to it for sure.
Correct. So if you work at a place and you know you're retiring in the next 5 years, that's a time where I'm a lot more open, and especially if you're at high income and when you're in those last years, that's a place where I'm a lot more open to it than I am when you're working there for a long time.
Yeah,
Because again, you can manage some things. Another option, another time is say you're an executive and you're exercising a lot of options. And so man, my income's going to just
big tax, you're
go
right.
really high. And again, if you got a 5 year time horizon, I'm a lot more interested in this than if you have a 15-year time horizon.
Yeah.
But
You know,
go ahead.
I was just gonna say the other thing that I get come across all the time is, but well, I need to put money into my retirement plan. Like, no, you need to have money for
Right.
retirement, right? In some
Yeah.
case, yeah, taking advantage of it. I mean, I'm saying it doesn't make sense, but also, listen, having money just stuck in a brokerage account that you can take and sell at capital gains tax rates down the road, like that's not losing the game,
Yeah.
right?
It's like
It's
the old fashioned way. just in a broker.
Yeah, yeah.
You
So
know,
that's the other thing. We get kind of brainwashed. Well, people when it's
tax
planning for
advantages.
college, I got to use
Yeah.
like college savings plan. I got to use a 401k. Like, yeah, it makes sense. But man, if you just got a bunch of money sitting in your brokerage account, you're gonna be pretty happy with that too, right?
The other thing is that you can end up having to take it at inopportune times. So sometimes people get laid off or fired, and then it gets paid immediately. So
Yeah, yeah,
it shouldn't evaporate. Does that
yeah,
make sense?
yeah.
Like, so unless a company goes bankrupt, it shouldn't evaporate. So but you could have like the whole point of this was to defer your compensation, but you might and get fired on November 1st after a whole year of high
Full
work
year of
and
income. Yep.
get it all in one lump sum on that day.
Yeah, yeah.
So
Well,
then you
and
just try to defer all this income, assume all this risk, and then you get it all that, and you shoot up you're in the highest bracket anyway.
right, right.
So it's, but I gotta say, I have a success story in this regard. So client,
Yeah, yeah,
not interested in my advice on this because they felt like their company was secure because of the way that the company was structured was a whole bunch of different infrastructure companies run this thing. So it's like a cooperative company. And so they were like, if this company goes down, these other places will come in and fix it. That makes sense. So our risk
yeah,
of bankrupt is a lot lower than, or not, I'm just not worried about it. And
yeah.
so yeah, they invested in their deferred comp. And then in these last several years, again, right before retirement, have really invested. And now they've got the first 5 years of retirement. They're retiring early, and they've got the first 5 retirement years of cash flow planned out. So it was good. Yeah, I
Yeah.
don't, hey, I actually, I guess I do mind being wrong, but sometimes I don't. It was a
Well,
great
it's
self-service
it's
person.
it's not that it doesn't work,
Right,
right? It's just that there's a lot of other risks, a lot of other factors that it's
right,
not the one solution, as opposed to, I'll say, 401k plan, like, I don't know,
right.
99.9%, like put money in your 401k plan is a generally
Yeah,
good plan, right? Like I
absolutely.
can say that almost
Well,
unequivocally.
and
Yeah,
401ks evaporating, that has to be fraud.
right,
This
right,
is, it doesn't have to be fraud for you to not get your deferred comp money. It just has to
right.
be that the company can't pay for it.
Yeah,
You
yeah,
know,
exactly. It's not wrong. But there's more risks and you have to
it,
account for that, right? It's not
it,
a slam
yeah,
dunk.
exactly.
Yeah.
So great time to wrap it up. One of my topic I like talking about. So I'm Bridget Sullivan Mermel, and I've got a family financial planning practice in Chicago, Illinois.
And I'm John Shear. I've got a field financial planning practice in Middleton, Wisconsin. Both Bridget and I are taking on new clients. We'd love to hear from you if you have a non-qualified deferred compensation question. But we're also both members of the Alliance of Comprehensive Planners. So if you like what you hear on our show and you'd like to find an advisor in your area that thinks like us, you can check out acplanners.org.
And don't forget to subscribe.